Jerome Powell of the Federal Reserve Board gave us the pause that refreshes. Got a bad feeling about this market. It seems like we're slowly going into a grind down. I think it's going to continue for a number of reasons. We have a looming government shutdown that could happen by September 30th if they don't come to some kind of agreement. But that's just a very background thing. Inflation looks like it's going to pick up, at least somewhat, with energy prices going higher this month. Oil has hit $95 per barrel at times, and they think ultimately it will hit $100 a barrel because the Saudis and the Russians cut production significantly. The 10-year yield has gone up to 4.35%. The secret here is they really are still increasing interest rates, only they're doing it on the long end. The Federal Reserve can impact short-term rates directly by raising the interest rate, but they also can raise interest rates on the long end, on the 10-year and 30-year end, by decreasing their balance sheet, which tends to raise interest rates on the long end. The 10-year yield has reached 4.35%, which is significant. The 2-year bond is above 5%. It's like 5.12%. We have higher rates, interest rates, and we've been guaranteed that it's going to be held for a lot longer. In fact, if we look at the dot plot where the Fed presidents, governors, they cast their vote about what's going to happen with interest rates, there's no cuts this year. They're projecting one more increase for this year. They do not get to their target of below 3%, like around 2.5%, until 2027. That's a lifetime in the stock market. I think we got plenty of bad news. The higher yields are leading to a strong dollar. And as bad as the United States is in its economic situation, we're actually way better than many countries. The dollar is in no danger of being replaced by any other currency, no matter what you hear to the contrary. Adding to fears of inflation is the possibility of a wage spiral. We see significant strikes happening. The United Auto Workers are striking and asking for a 40% increase over some years, along with significant benefits increases. If these strikes spread, this could have a massive impact on the economy. The Fed's decreasing its balance sheet isn't being talked about at all. They're letting them mature, the bonds that they hold, and they're about 100 billion of their bonds become mature each month. That has a deflationary effect because it raises interest rates, which decreases spending. Also, we had significant IPOs this week. ARM, they designed the chips that are put into just about every cell phone and other computer instruments. They did an IPO and they shot up. They went real high at first, but now has come down. And also Instacart, which is a grocery delivery service, just came in and it spiked up to like $43 on its first day. Then it came down to $33. They thought it was successful because they planned the initial price to be $30. But if you look at the chart, it started out at 42 and then comes down to 33 or so. Traders looking at this considered it a massive failure. I think both of these IPOs are going to be very lackluster. I think it contributes to concerns about the stock market. We have some interesting other trends that are explainable by the situation, such as EV sales, electric vehicle sales in Europe are up 21%. I think that might be at least partially due, or even mainly due, to the price of gas. People are turning to electric vehicles. It costs about a third as much to run an electric vehicle, to pay for that electricity, than to pay for gas for an internal combustion engine. On September 21st, England will set their interest rate. I think they're expected to raise it, but they talk about cutting it, which is ridiculous. Keeping it the same even would be ridiculous. They were expecting to get a 7.0 CPI, and they got a lower than expected CPI of 6.7. We're thinking, oh, maybe they're going to pause. Some people in the press were thinking that, which seems just delusional. They are so much in worse shape than the United States. It's almost pathetic. The yield curve has has been seriously inverted for 14 months, and that's a major sign that a recession could occur. And it's really surprising it hasn't occurred. They just recently raised interest rates to 5.5%, and that 5.5% won't come into full effect until about a year from now or more. Year to 18 months is usually what they say. What we're going to hit a maturity wall. And what that is that a lot of people are kind of hiding out with their loans, long-term loans that they made when interest rates were near zero. You got a 30-year interest rate on your house that's 3 point something. You know, you're going to hang on to that, your house. That's why nobody's selling their house anymore. Corporations, they have $1.8 trillion of debt that have to be refinanced by the end of 2025. When they refinance it, they're not going to get the low interest rates. They're going to get quadruple interest rates, at least, of what they had before. That maturity wall is going to hit. They're going to have to refinance at a much higher rate, which is going to significantly slow the economy, if not send it directly into a recession. A hopeful sign for the future. Eventually, we'll get past this recession. I think we are going to go into it, a moderate recession. It's coming slow, and there's all kinds of reason for that. Part of it is that the government, Biden and Congress, have been pumping money into the economy with the Semiconductor Act, with the support for the war in Ukraine, which stimulates all kinds of industries. These kinds of things, and the Inflation Reduction Act really propels the economy forward too. You have these things that are probably inflationary, but are saving the economy. Do I want them to go away? No. If we didn't have those things, we would be in a recession for sure, which is why the recession is so slow in coming. I think it is going to come. The hopeful thing is that money market inflows are just amazing. Money markets are paying 5% or even more. We're going to have this massive stash of money so that when things do turn around the other way, we should have a tremendous bull market. I think we're going to have to go through a recession first. What troubles me and many other observers of the stock market is that there's a lack of breadth, that you have the mega caps like Tesla and Nvidia that are doing very well, but it hasn't spread out to other areas like industrials. Even smaller stocks especially have not participated as much. The S&P 500 year to date has gone up about 15%, but they have an even weighted S&P 500 ETF, and the even weighted S&P 500 ETF has only gone up a paltry 4%. So there's quite a big difference between the haves and the have-nots, and the big technology companies have really held sway over the entire market, although they seem to be starting to falter, which is a bad sign because they compose about 40% of the S&P 500. Thanks for listening and watching. Be sure to like and subscribe, and I'll plan to see you in the next one. Thank you.